So guys, if you remember in my last video, I gave you 5 UK stocks which might be interesting buys right now, and I gave you the option of picking one of them for me to analyze in this video, and the majority of the comments tended to point towards Unilever. So we're going to look at Unilever from a financial perspective, from an investor's perspective, and also from a business perspective to determine is it something that you would invest in right now. So let's get into the video. Welcome back to Millennials with Money. My name is Johnny, and just before I head over to the computer where I'll walk you through this analysis, just a reminder that what you see in this video is not financial advice and it's not an investment recommendation. So do your own research as well. If you decide that you'd like to invest in Unilever, do not rely solely on this video. Disclaimer out of the way now, let's go over to the computer and let's have a look in detail at Unilever. Okay guys, let's get right into the analysis. So we've got the usual 4 areas that I look at when I analyze stocks. So we've got the financial performance of the company, we've got its debt situation, its cash flow situation, and investor KPIs that might interest us as an investor. So let's start with the financial performance of Unilever. So the first 2 we're going to look at is gross margin percentage and net income percentage. And we're going to jump over into Morningstar to have a look at these, just so we can see a bit of the historical data as well. Now remember, your gross margin is your revenue minus your cost of sales, and your net income is the absolute bottom figure once you've deducted from those revenues the cost of sales, your operating expenses, depreciation, and any taxes that need to be paid. So net income is essentially the absolute bottom line that the company is left with after everything else has been taken off. So gross margin, if we take a look, you can see in 2011 it was around 40%. Over time it's gotten better, it's around about 44% now in 2019, 2020. So that means that once you've taken away the cost of the product, the cost of generating that revenue, you've got about 44% of your revenue still left over before you get down into the next line in the P&L. And then from a net margin percentage, that's remained pretty constant. That's been around about the 10% mark. They had a good year in 2018, up to 18% there. Around about 10, 11%. Constantly though. So 2 things to point out here. The first is that it's really good to see stability. It means that as times are evolving, as the business is changing, they're still able to manage their costs and manage their cost of operating to be able to generate a good net margin percentage and a good gross margin percentage as well from selling the product. However, the net margin percentage is a bit more relevant than the gross in this example, as an investor, your dividends are going to be paid from the net margin percentage. So ideally, the better the net margin, I tend to look for around about 10 or 20% net margin. That gives me comfort and assurance that the company is long-term profitable, regularly profitable, and that there's a good chance that they're going to have the cash to pay me out a dividend. Also, ideally, we'd want to have a comparison with other companies when it comes to these, particularly when it comes to gross margin, as 44% gross margin in Unilever's sector might be amazing in one sector, or it may be really, really bad in another sector. So it's really important to have a bit of a wider context, ideally, when we're doing stock analysis. For the purpose of this analysis, though, we can say that the net margin is pretty good. It's quite reassuring as an investor that the company is long-term profitable, and it's very stable over the time, as we've seen. Next, we've got the revenue growth percentage, and we've got the net income growth percentage. Now, ideally, we do this over 10 years. So I actually went and pulled from Unilever's website the 2010 to 2014 revenues, and the same for their profits. So I'm just gonna, let me just make a quick update to this file and do those calculations. So let me show you how I've done this. So if I take, let's start with comparing 2011 to 2010. So we'll divide the 2011 revenues by 2010, and we will do -1 as well, as that will tell us what is the growth percentage. So you'll notice what I've done here is I've calculated the year-on-year growth. I've said this in previous videos. You can do your average growth from 2010 to 2019, for example. But personally, I think it's better to look at year-on-year growth, because you could have your average growth over 10 years drastically inflated by one good year where you could have been declining for many years. I think it's better to look at year on year, because you can see if a company is regularly growing their revenues, their income, which is what you ideally want. So you can see in the case of Unilever, there were 5 out of 9 years where they managed to achieve positive revenue growth, so that's a good sign. And then if we take now the average growth over 10 years, so we see the average down there, it's about 1.93%. So that's good. They're managing to grow their revenue at about 1.93% annually. Remember, of course, this can be impacted by extreme figures. So if you ever do see that in a company when you're analyzing, you might want to exclude it or just find out what the reason was for the extreme increase or decrease. Now let's do the same with the net income growth percentage. So essentially, I'm just gonna take this line here, jump down the page. Whoop, there we go. So net income available to common stockholders. And I'm gonna copy that formula there. As I was editing the video and watched back this part, I realized that first of all, I'd made a mistake in one of my calculations here, and that second, you couldn't really see what was originally on the screen. So what I did in the end is copy the formula down and apply it again, but as you can see in extreme value in 2018, I decided to exclude it from the calculation and simply calculate this last growth percentage based on 2019 versus 2017, and the average of all the growth on the whole was 2.88%. It's good to see that the company is continually growing their net income percentage over 10 years. So what can we say from a financial performance perspective? You know, things are looking pretty good. The gross margin, it's a bit difficult to give it any real meaning without assessing it with its competitors. The net income percentage, similar, but as it's around about 11%, yeah, it's pretty good. That shows us that the company's profitable, and we've seen over the long term that it's round about that 10% mark, so that's quite comforting. And we've seen that the company over time is capable of consistently growing its revenues and its net income percentage. So that's really good from a financial performance perspective. Now let's look at the debt situation of Unilever. So if we start with the current ratio. So this current ratio is calculated based on data on the company's balance sheet. Now the balance sheet essentially shows you on one side the assets, so things of monetary value that the company possesses, and liabilities, so money or debts that it owes to creditors that need to be paid. And within these liabilities and assets, you have current and non-current. So current are short term, so from an assets perspective, anything that the company has can be converted into cash within a year. So that might be actual physical cash that it has, money that it's owed from customers. And on the liability side, similar. So debts that they need to be paid off within a year, or money that they owe to suppliers, etc., etc. So the idea of the current ratio is to say that in the worst case scenario, how much coverage does the company have for its short-term liabilities? Is it able to cover them with the current assets it has in the short term? So a current ratio of 1 or greater would imply that yes, it can, and a current ratio of less would imply no, it can't. So ideally 1 or greater is a good current ratio to have for your company. Now, is this good news? Is this bad news? It's not ideal. It's below 1, but it's not a huge amount before 1. And the idea that the absolute worst case scenario would come where in one moment in time all those current liabilities need to be paid off is very unlikely. So it's probably okay. And we can also, when we get to the cash flow situation, if we can see that the company is doing okay with its cash flows, then we might be able to worry a little bit less about this current ratio. Now let's look at the gearing percentage. So when you think about how a company runs, it obviously needs money to run. Investors or lenders give in money so that that company can run. And the gearing percentage essentially says what percentage of that finance that the company is running on comes from debt financing. So essentially what we need to do is take the total of that debt and divide it by the debt plus the equity to get the percentage of the debt. So I've got the balance sheet here. So don't be too scared by this. I've just picked out the lines that we need. So we've got current financial liabilities. So any money that's owed to lenders within less than a year. And we've got financial liabilities non-current, so any money that's owed in a year's time or later than that. And then down here we've got the total equity. So I did this calculation. You can see about 5 years ago they were running at about 50% gearing, so 50% of the company's finance was coming from debt financing. Then in 2017 that increased greatly. That went up to 62%, and we're now at 66-67%. That is very high, and I would generally be quite uncomfortable with such a high gearing percentage. And if we try and figure out what's gone on here, so we can see that the financial liabilities of the company have increased greatly as time's gone on. So that means they're taking on more debt. And you can see as well, equity has gone down. So obviously if you reduce the equity, increase the debt, then a greater percentage is coming from debt. Now, why might this be cause for concern? Especially when you think debt finance is typically cheaper than equity finance, because the interest rates on debt typically lower than the return on investment that an investor would expect. So the company can operate for cheaper on more debt. The difference, of course, comes in the fact that with equity, investors are putting their capital at stake and there is no guarantee that they will get that capital back. Whereas when it comes to debt, there is an obligation to repay. So there's now a risk that that debt doesn't get paid. So that's why higher gearing percentage indicates more risk, and you might want to be more risk tolerant when it comes to debt financing if you're investing in companies with a high gearing percentage. Okay, so now the cash situation. So how is the company handling its cash? So at present, Unilever has about £4 billion in cash on the books. So let's go to Morningstar and have a look at that in a bit more detail. There you see it at the end of 2019, they had $4 billion in cash. So that's quite nice, but obviously we want to see how that's looking over the long term. So if we have a look here, we can see that the cash that they have at the end of each year is generally growing up. So that's really good. If we have a look at this in a bit more detail, so cash flow from operating activities, that is essentially money that's coming in from their day-to-day business. Cash flow from investing activities, so if they're buying or selling properties, plants and equipment, it will come in here. And then cash flow from financing activities, so this is essentially if they're taking on new debt, if they're paying dividends, if they're issuing new shares and getting investors to pay in money to the company in the form of buying new shares. So I'm going to keep this high level just for the analysis, but you can see the cash flow generated from the operating activities is covering their investments and most likely their debt repayments that they have. So things look good from a cash flow perspective for Unilever. And then one final metric I like to look at as well is the receivables turnover. So we go back to Morningstar, we're going to go to the operating performance tab, it's in there. Now receivables turnover, so if we go back to the balance sheet, you remember I mentioned in assets, companies can declare money that they're owed from debtors, from clients that still haven't paid them. So that's essentially saying of those receivables, the money they're owed from clients, what percentage of their turnover, their total sales is that? So you can see here, they've actually done a good job. Over time, that's decreased. So they've managed to get it down from 17% down to about 11-12%. Again, for this to have a bit more meaning, it would be good to compare it to other companies that are in Unilever's sector, maybe the likes of Nestle, the likes of Mondelez, for example. So yeah, we can't talk too much about it right now. But overall, from a cash flow situation, things seem pretty good for Unilever. So that might ease some of our worries when it comes to their debt situation. And last but not least, let's come to the investor KPIs. So we'll start with the dividend yield. Now, think about a dividend yield as your return on investment in the form of a dividend. So if you pay 100 euros for one share of a particular company and that company pays out 5 euros per share as their dividend, then you've made a 5% return on investment. Your dividend yield is 5%. This is where it gets really interesting and where the idea of buying low can become really attractive. So let's say, for example, that share price goes down to 95 euros per share, but that is still a 5 euro dividend. So our dividend yield would increase in that case and it would become 5.3% about. So obviously when people think about buying the dip or when the market crashes, buy stocks Not just because the stock can recover back to a normal price, but also because you can get a really nice dividend yield in good companies as a result. And the dividend yield's important because remember, when you invest in a company, you're putting your own money at risk. So you want that risk to be worth it. Like there has to be a good return on the table for you as an investor for it to be worthwhile. In the case of Unilever, you can see there's a 3.81% dividend yield, which, you know, there's companies that have better dividend yields out there, but it's an acceptable dividend yield. We'll give it that, you know. No, 3.81% beats for sure the interest on in your savings account. So yeah, and Unilever is a stable company, as we'll see in just a minute. So the payout ratio, so how much of the company's net income are they paying out as dividends? So there's a sweet spot for this. Now, people typically say between about 25-30% up to about 65% is the sweet spot. Because if they're paying out a dividend, but they're only paying out about 20% of their income in dividends, then you might be thinking as an investor, well, hang on, they could be giving me a lot more money for my investment that I'm making. You've also got the other end of the scale where they could be paying out 80, 90, 100% of what they earn in dividends. And that quite simply over the long term is not sustainable. The company could run into cash flow problems as a result of that by trying to appease investors and meet their dividend commitments. So we see in the case of Unilever, they're at the upper end of that spectrum. They actually gone over it in 2019, as we'll see. We'll go to the dividend section now, and I'll show you what that looks like over the long term. So actually that's 77%, 72% actually. It seems to be a one-off. So if we look at the history, that's more or less stayed around about the 60 to 65% mark. So I think we don't need to be too concerned about that. It's at the upper limit, but it's still within. So that's okay from a payout perspective. Dividend interruptions. Now this is really important to look at, because if you invest in a dividend company, it's obviously because you want those dividends. So how is the best way to assure yourself that you will get paid those dividends? Is to look at the company's dividend history. Because if a company has gone years and years and years without dividend interruptions, that means they've paid out dividends consistently, whether the economy is good, whether it's bad, whether there's, you know, a health crisis going on. It's a good indicator that whatever the situation, they are faithful and they are committed to paying out dividends to their shareholders long term. And you can see in the case of Unilever that there's been 0 dividend interruptions. I'm going to jump over to Yahoo Finance now. So if we look here, we're in 2021. These records go back to about 1996. So every single year since 1996, Unilever has paid a dividend. Now that is a good indicator that they will continue to do so over the long term. So really good track record for dividends has Unilever. And finally, we'll look at the price to earnings ratio of Unilever. So the price to earnings ratio, let me jump over to Investopedia for just 1 second. What this essentially does is it takes the current share price of the company and divides it by its earnings per share. If we go a bit further down the article, we can see that the price to earnings ratio is an equivalent way of saying for every £1 in this case, so for every £1 of income that Unilever generates of earnings, how much am I willing to pay as an investor? So as we'll see, we'll go to the valuation section in Morningstar and we'll see that that is about 21 is the price to earnings ratio. So that's to say that for every £1 that Unilever generates in income, investors are willing to pay about £21. Now ideally you want your PE ratio to be low, because that indicates that the stock is cheap at that moment in time. So you can see in 2019 Unilever was maybe a bit cheaper than it is in 2020. But 20 is, you know, it's still a good price to earnings ratio. It does indicate the stock might be quite cheap at the moment, But again, as with many things that we've seen through this analysis, it's always good to be able to compare it to competitors in the same sector to see how it weighs up against them, because that will give a more broader comparison and a bit more context to what's going on in that specific sector. So from an investor KPI perspective, Unilever is looking good. So that dividend yield is about 4%. They're paying out the upper limit of their income in dividends, so we can accept that. There's no dividend interruptions in its history, so we can be pretty confident that that is likely going to continue going forward. No guarantee, of course, but very likely based on its history. And from a PE ratio perspective, it looks to be quite cheap. And that's all from a financial perspective. What I also like to do is have a look at the company's website, see what they're all about. Let's look at the Unilever brands. Now remember, let's look at this. You got Cif, Cornetto, Comfort, Dove Men Care, Hellmann's, so your mayonnaises there, Magnums, Ice Lollies. You get the picture though, right? Look at these brands. They're brands that you use on an everyday basis. So Unilever, clearly from a brand portfolio perspective, that is strong. And obviously there's clearly demand for these brands, as we've seen in the revenues. You know, those revenues around about that 50 billion GBP mark per year, and it's slowly growing as well. So Unilever knows how to keep their brand portfolio relevant and strong. What else might we want to look at? Strategies. Now the business strategy, obviously very important as well. So okay, sustainable growth. I think it's become pretty apparent that we've also already seen around the website that sustainable growth is something that's very key in how Unilever works and operates. I'm not going to take you through all of these. Let's just look at the climate action one. But you can see sustainability. So these are the United Nations sustainability goals. So obviously their strategy, they've built it somewhat around that, which is obviously really good. And from a brand image perspective, should do the company quite nicely. Obviously, it's good to understand how the company works, how it operates. But I think Unilever's business it's quite self-explanatory. It's not too difficult to get a grasp of how it's operating. So from Unilever, I think that's okay. And then a last thing I like to do as well is just pop in a quick Google search, Unilever. So this is all about diversity, equity and inclusiveness, which obviously they mention on their website as well. It's all basically around this normal campaign. So I think it's obviously made the news. And then obviously just from a stock perspective, now remember, when you look at what other people are saying, that is just their opinion. Try and withdraw only the facts if you're going to look at what other people are saying. So you can see, what do we see here? Obviously, one of the world's largest consumer goods companies. The share price has dropped, but you can see almost a third of the global population use Unilever products. Then he goes on to say, I think it's a good opportunity to start a position in the company. Now, all I focused on there, I just focused on this first paragraph because these are the facts. I agree with his opinion. I think it's a good buy right now. But remember, as well as it's good to understand his opinion and see what he's saying, you know, again, he says about, there you go, 1929, Unilever has been paying dividends since. But yeah, the important thing is focus on the facts. Don't invest in Unilever or don't invest in any company just because someone else thinks it's a good buy, because as many people think that it is a good buy, there's probably a same or a similar number that don't think it's a good buy. So it really comes down to your opinion. So to conclude this analysis, honestly, I think Unilever is a really good company to invest in right now. Solid financial performance historically. Yeah, the debt situation, it's not ideal, but you know, from a cash situation, it's all right. And you know, this is not like a struggling business. Like as we saw, a third of the world's population is using Unilever products. And from an investor perspective, yeah, you can probably expect a nice return on your investment, both from a dividend perspective and because it's trading quite low, might indicate that the price over time could also go up. So guys, from this analysis, I can tell you Unilever was in fact one of the companies that I added to my trading 212 pie following that earlier video this week. And I think this analysis really backs up exactly why I would want to invest in Unilever and why you as well might want to invest in Unilever. But of course, as I said at the start, do your own research as well. So if you enjoyed this video and found it helpful, why not leave a comment down below, let me know, give me your thoughts on Unilever, and also I know there was a lot of people that also wanted to see BAE systems analysed as well. So if you would like to see a similar video for BAE systems, then why not leave a comment as well and let me know. Now, does the money gun want to cooperate today? Oh yes, it does. Okay guys, I'll see you on the next one, and let's get this money.